Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, October 24th, and then we'll see how things look for Wednesday, October 25th. We had a bit of a bounce. We were able to get back above the 200-day simple moving average for the S&P. That's a positive thing. We've worked off some of this short-term extreme negative reading that we've been seeing. You'll see the list is quite a bit shorter, but we're still negative in the bigger picture. We have to see where we go from here. As far as, is this the start of something that's going to continue to go up, or is this just a little bit of a bounce before we get set to go lower? Let's go back and talk about what happened. Right at the open, we had a higher open above the 200-day simple moving average. That was positive right off the bat, and the fact that we were able to hang on to that is a good sign, at least for right now and in the longer term. We climbed above our one at 42.52. As the day went on, prices fell back to the 200-day simple moving average. We ended up finding support at the daily pivot at 42.21. Then we rebounded back to the 200-day simple moving average. We got back up to R1, and then we ended up closing just slightly below R1. So we were up 0.73% on above average volume. We're still negative in the bigger picture with our technicals, even though we're working off some of the short-term extreme condition that we had been seeing. It's about inflation, interest rates, growth concerns. Right now, it's earnings season is also playing into that. And then what is happening in Israel? Is that going to escalate even further than it already has? Some comments that we can make. The S&P did close back above its 200-day simple moving average. There's still this fear of an escalation of the war that's going on in Israel. The mega caps did outperform. They've been the real strong part of the market in 2023. They're continuing to do that, at least in Tuesday's session. Oil did close down, which helped stocks a little bit. It closed at 83.79. This was another area that is showing some weakness. Bank stocks. There's concerns about credit quality, deposit costs, and weakening loan demand. Now, this hasn't just been a revelation that's come true right in Tuesday's session. This has been building up over a period of time, and then they just decided to create this as a concern on Tuesday. The micro caps are still near their 52-week low. They did bounce up a bit in Tuesday's session. Our list of extreme negative readings in the short term is getting a lot shorter. We still have the 20-period exponential moving average, as well as the stochastics. Intermediate term, we still have the 50-period exponential moving average, the Arun, as well as the bullish percent index for the S&P 500. Long term, we're still below that 150-period moving average. The scenario that we've been dealing with is the same one that's been going on for a couple of months now, that the economy is potentially stronger than expected, that the Fed is going to have to keep rates higher for longer and possibly even raise rates. We're watching the Chinese economy. They've been putting some stimulus into that economy, which may come through and actually help S&P 500 companies. The war in Israel, as well as keeping an eye on oil prices. And then we're in the middle of earnings season, and that's having quite an impact. The dollar was up and interest rates were up. And then the 30 to the 5 and the 10 to the 5, those are still back to being normal. And we're seeing some improvements still with the 10 to the 2-year and the 10 to the 3-month, but they are currently inverted and have been so for quite a while now. Sentiment did improve. We're at 32 where we had been at 27. Our trend is still negative. The red line's still on top. We're showing a confirmed strengthening trend, even though the red line did come down slightly. And I'll show you a chart of that. I'm keeping our bias at mixed right now. Even though it was an up day, we still have kind of a negative backdrop that we're dealing with. And our momentum in the bigger 2, 3, 4, 5 day picture is continuing to be negative until we are proven otherwise. We did get the S&P Global U.S. Services PMI. And this is one of the changes that we've seen in the U.S. economy, where we used to be a manufacturing economy. And over the last 40, 50, 60, 70 years, we've switched more to a services type of economy. And so the fact that we're above 50, that shows slight expansion in the economy. And it came in actually stronger than the 50.1 that we had last time. And it came in at 50.9 this time. Where manufacturing, we're not as big of a manufacturing economy as we used to be. We came in right at 50. That's the line in the sand. Above 50 shows expansion in the economy. Below 50 shows contraction, where last time we did come in at 49.8. Here's a chart showing the manufacturing, and it's coming in right at 50, and it's showing some improvement from what we've been seeing over the summer. And we're seeing a little bit of weakness here with the services, but we're still above 50, showing some expansion in the economy and actually a bit of a bounce from the previous reading. We ended up coming in at 4.84% for the 10-year yield. That's still above the 4.02%, which is causing concerns for earnings. And then here's the intraday chart where we didn't gap all that much, but we did have a higher open. We immediately shot up to R1. We just chopped sideways. There wasn't a lot of initial gyration that usually happens. We went above R1, then we came back down to the 200-day simple moving average, which is now at 42.37. It recalculates every day. We dropped down to the daily pivot, and it's looked like, okay, are we going to turn more negative now? Nope. This ended up providing support. And then later in the day, we saw a nice little bounce back above the 200-day simple moving average, back up to R1, and then we closed slightly below R1. We did see some improvement here with large cap growth versus value. Growth did outperform value, and both of them ended up being positive. But this is a little bit of a concern where after Monday's session, it's like, okay, growth did quite well. Well, it didn't do quite as well on this chart when we look at the intraday ratio between S&P growth versus value. We're still holding up okay as far as the end of day chart when we look at growth versus value. It did decline since it slightly underperformed on a closing basis, but longer term, we're still in an uptrend. We're also keeping an eye on this, discretionary. It bounced up a little bit, but we do have a recent a death cross here when we look at the equal weight ETF. And this has been a stronger area in 2023. The fact that this is showing some weakness is a bit of a concern to us. Then we look at the Staples equal weight ETF, which has been under a lot of pressure for quite some time and not really a surprise. We look at the ratio between the two where it ticked up just a little bit and it's still in a longer term uptrend, but it's been seeing some short to intermediate term weakness as of late. Here's the condition of our trend where the ADX is above 20 and above its moving average. That's a confirmed trend. The red line is on top, even though it declined. So that's still a confirmed negative trend. We're seeing the same thing with the short-term chart, above 20, above the moving average, red line on top, even though it declined. We're also keeping an eye on the VIX, where we look at an average from 1990 up to 2022, where maybe we're seeing a bit of a bounce down with this right now before we get set to go a little bit lower. The Ulcer Index is still continuing to go up, showing that fear is increasing. But we did see a decrease with the VIX. It came back down under 20 on the line chart. That's the closing value. And we also dropped below 20 on the bar chart and closed near the lower end of the bar. Volatility is also starting to come back down. Where it had got pretty high ahead of the weekend, it's starting to actually retreat now, but it's still above the moving average, both with the bar chart and with the line chart. We're continuing to go up with our VIX to VVIX ratio. That's more longer term negative. And again, 2 days in a row, imagine that. I have the 1 day chart of the equity put call ratio where we ticked back up just slightly, which is kind of interesting. This was an up day. Usually this would continue to go down. So I just wanted to show you that. But our 5 period is still continuing to decline, and that could be positive for the market. We get a solid down day though, and we see the equity put call ratio really going up, and that could turn this moving average back up. Longer term, we're still looking more negative with the 253 period simple moving average continuing to go higher. And here's a longer term look at the 5 period moving average chart where we have become extreme positive here above 0.8, and now we are continuing to fall, and you can compare that to other times and then what the S&P did in response to that. We're coming down a bit with this one fear gauge that we look at, but our risk on risk off ratio continues to show some weakness. It was even down a little bit in Tuesday's session. The mass index, we're coming closer to that blue line. We're going to be watching this. If we go above the blue line, turn, come back down below the blue line, and then down below the red dash line, that's when a signal will be generated. And usually it's trying to predict that there will be a reversal in the market. The advanced decline line did show a little bit of a tick up based on price and volume, but both are still below their moving averages. We did see a real expansion of the new lows, not as much as what we saw on Monday, but it's still really outweighing any kind of new highs. That's turning our 5 period and our 10 period down. We saw a bit of a bounce with the advanced decline ratio, but we're still below zero, both with the blue line and the red line. Accumulation distribution did turn up just a little bit, but we're still below the moving average. Chicken money flow, this is where we saw a little bit more improvement, where we had actually dropped negative after Monday. We're back to looking more positive after Tuesday. And we're a little bit above the 200-day simple moving average here on our daily chart. On the bottom, you can see where we're still above average. We're really watching this level right now to see if we're going to maintain closing price above these previous lows. Volume still continues to be above average, and we're still turning up a little bit with our 20-period exponential moving average, but we're still extreme negative. We're also turning up with the 50, and we're flattening out a bit with the 200. So these two moving averages are still extreme negative. The force index showed a little bit of an improvement, but is still negative. The stochastics in the short term were no longer extreme negative. Now we're more extreme negative in the intermediate short term, and we're still declining in the long short term. And the reason why I say that, I have to explain this once or twice a week, is when I say short term, this is a further division of the short term time frame. And instead of coming up with different terms, I just go short term, intermediate short term, and long short term. The Erin indicator ticked up just a little bit, but we are still working off of that pretty extreme negative reading. And we saw a bit of a bounce with the cumulative advanced decline line for the NYSE, but still it has some real work to do to turn more positive. We almost came down to this previous low with our regular advanced decline line before ticking up slightly. We're still negative, though, with the Swenlin trading oscillator based on price and volume, and we're not extreme negative yet. We're still negative with the go, no-go system with the deep purple bar. The TTM squeeze is also looking more negative. It's just barely positive, but it has been declining another day or two, and it could switch back to red. The balance of power is still looking a little bit more positive. We're above the dashed line, even though it decreased slightly on Tuesday. And we're kind of flattening out here with our highest high, lowest low values. What I'm watching right now is the green midpoint, and that is starting to come back down. We're just a little bit above the 200-day simple moving average. The vortex, even though the red line turned down and the green line went up, the red line is still on top. That's negative. The ease of movement showing a little bit of improvement, crossing just barely back above zero. That's turning slightly positive. The bullish percent index is still continuing to drop. Even on an up day, we still saw this really decrease. When we're really going to possibly get excited about this is when we finally bottom out and then come back and cross back above 30. That would be a buy signal for this indicator. However, the summation index based on price and volume continued to decline. Also, price and volume for the NYSE summation index are also declining. We're still negative with the Elder Impulse system for the S&P. The RSI ticking up just a little bit with the 14 and the 9 period, but we're still below 50. That is negative. On balance volume ticked up slightly, but is still below a declining moving average. We turned up a little bit with our 200-day moving average study and our 50-period moving average study, but they've got a lot to do to repair the damage that's been done. We're still well below the 100% retracement level. We're still above this other fib level in here as well. We're watching this to see if we start to go up, that might be resistance. If we continue to go down, this might provide support. Also, we're above the 50% retracement level on our longer term fib chart, and we're still watching this to see if we fall, will this provide support? Longer term intraday on Monday, we did close or come down below this fib level, but so far we've been closing above it. So for right now, these longer term double fib lines that we have right here are continuing to hold. We're also keeping an eye on this quadrant level, where if we continue to come down, will this area end up providing support? The Coppet curve, the signal's almost ready to go away. So it's pretty much not working right now. The Pring bottom fisher, though, is still giving us some kind of a crazy buy signal. I don't know, maybe it's seeing something that we're not, but looking at the chart, you just can't justify that. On a momentum basis, we're still negative. The PMO is declining. We're crossing over based on price and volume, but we don't have anything extreme right now. The PMOs that are rising did tick up slightly. We're still declining with the buy signals, and we're declining with the PMOs that are above zero. The NYSE bullish percent index continues to be negative and not extreme, where the NASDAQ 100 bullish percent index ticked up a little bit, but is still below 50 and is negative. The slope oscillator, so our short-term momentum continues to be down. Our intermediate term momentum is also down with the MACD. All of our indicators, the short and intermediate term, those are negative. We're rolling over with our longer-term oscillators with the TRIX and the KST. We're back above the 200-day simple moving average. And we're coming back up between the border of -1 and -2 with our standard deviations chart. The Chaikin oscillator ticked back up just slightly, but is still negative, below zero. We're also below zero with the money flow index, turning up a little bit, but still negative with the ultimate oscillator. We're still negative with the parabolic SAR. We're still above this parallel trend line here, going from this high down to this other high. And so far, this level of support has been holding. If we fall down below this, I also have a more defined trend line, the blue line, going from this low to see if that will end up providing support. We're still below the extreme negative reading with the 150-day simple moving average, even though we ticked up slightly. Special K is still right on top of its red moving average line. We saw a bit of a tick up with the Dow. The transports were pretty much flat, and we saw a bit of a bounce with the utilities. There's the Horchak. This is a longer-term buy signal after being extreme or very positive for most of 2023, is still showing that weakness. We're going to have to see a lot more improvement for this to go back up. If we see more weakness, we might continue to see this go down. The Staples to S&P 500 ratio, this is not necessarily giving support to the S&P right now. This ratio is going up, even though in the longer term, it has been going down. The S&P to utilities ratio also is declining now, where when this is going up, that tends to give support to the S&P. The 10-day average of the S&P 500 highs minus the lows after getting extreme negative, we were showing some improvement, but now we're still continuing to decline. And we're still below zero with our 19-day exponential moving average of the advanced decline ratio. We're below based on price and volume. So this isn't showing an awful lot of improvement, even though both areas bounced slightly. We're coming off of the low set yesterday with the micro caps setting a new 52-week low. The Heiken Ashi continues to be negative. The Kegi chart is negative. Even though it's a red line and it's pointing up, that means it's negative because it's red. It has more of a positive flare to it right now because it's pointing up instead of down. The Renko chart is still negative, and the three-line break is still negative. The equal weight did bounce up slightly, but it's really underperforming the S&P 500 weighted index. And we're seeing this here with our ratio between the S&P and the S&P equal weight. This is continuing to go up as the mega caps are outperforming. We're still maintaining support with the Dow. We were able to bounce up off of this, but we're still well below the 200-day moving average. We're still negative with the Elder Impulse system for the diamonds, and we're still hanging in there with support with the NASDAQ 100. We're not really breaking out to the upside, but we're not breaking any more to the downside either. And we have switched back to neutral for the Elder Impulse system on the QQQs. We're still negative on a momentum basis for the NASDAQ 100. The PPO is below its moving average and below zero. And we're still keeping an eye on the 61.8% retracement level for the NASDAQ 100. So far, this level has held. And we saw a bit of a bounce with the NASDAQ, but we're still below the 50, still above the 200. And the NASDAQ is coming right back up to this 50% retracement level. This has been just a real ping pong match going back and forth here, going back to the summer months. We're still negative with the small caps. We did bounce up a little over 0.5%, but we have a recent death cross here. And the Russell 2000 also still looking negative. We bounced up with the RSI, working off of a death cross, but on a momentum basis, we're still negative. And the small caps have switched back to neutral. The mid caps also recent death cross. We're up a little over 0.5%. After really getting hit over the last few days, we're still negative with the Elder's Impulse system for the mid caps. The FANG index, this has had a couple of good days. Now, these are the big mega cap companies, but this index is still below its 50-day moving average, even though longer term, it's still in an uptrend. And we're coming right back up to the underside of our arithmetic long-term trend line here, going back to 2009. Looking at growth versus value, the Qs are outperforming the S&P. That turned up. We're seeing a little bit of a bounce here with discretionary to the S&P, and large cap growth is outperforming large cap value. Looking at other growth to value ratios, the large caps are showing some improvement, not much with the mid caps, and we're actually declining a bit with the small caps. Our 50-period exponential moving average of the new highs minus the new lows continues to decline. That's longer term negative. Even though we ticked up just a little bit with the black line, which is our indicator, we're still well below zero. So that's causing the red line, which is the 50-day exponential moving average, to continue to decline. Looking at the 50-period moving average study of the stocks in the S&P, we did get extreme negative. We were showing some improvement, and we actually ticked up just a little bit, but we're still not looking very positive. Also, not looking all that positive for the mid caps or with the small caps. We see any more weakness here, we could actually get down to the point of giving an extreme negative reading. When we look at the broad market range of the highs minus the lows and take a 5-period moving average of that, we're continuing to decline. And on an up day, you would expect this to show some improvement, but it did not. The dollar continues to be in an uptrend. The financial sector continues to be below its 200-day moving average another day or two, and that could generate a death cross. We're still maintaining price above support, though, with the financial sector. So we're watching this. We're also chomping our way through the new 50-day cycle, where here we look at the 10-year bond yield, where they did come down on the day, even though longer-term rates have been going up. The 30 to the 5 is still above zero and showing improvement, as is the 10 to the 5-year. And we're still seeing a pretty strong correlation between the U.S. 10-year yield, and we subtract the German 10-year yield, which is giving us a positive answer. The dollar continues to go up, and the correlation is still strong between the two. And as I've been saying, this is probably negative for stocks. Here's Tom Bowley's research, where we're coming more into the middle part, where we tend to see some weakness now before we see a bounce going into the latter part of October. So what's our outlook for Wednesday? We're still dealing with earnings. We're going to get Meta on Wednesday. We're going to get Amazon on Thursday. The UAW strike is still continuing. There's still not a new Speaker of the House. We're watching the situation in Israel to see if that escalates. The technicals are negative, but we're back above the long-term support, meaning the 200-day simple moving average. We'll get the weekly MBA mortgage applications index, new home sales, and then we're keeping an eye on all the geopolitical events, with the big one really being what's going on in Israel. Here's the updated economic calendar. We're on Thursday. We're going to get GDP, and that could be rather significant. That'll be the first time we're seeing this number. And then on Friday, we're going to get another inflation number with the PCE prices. For October 25th, we're neutral to negative for the Dow and S&P when we look at the Stock Traders Almanac statistics, where we're neutral to positive. Now, that's taking all the years from 2001 to 2021, and we're also in the week after options expiration, where we tend to be negative more than positive. This is a part that's a little bit of a concern. This is looking at the pre-election year. And on the 18th trading day of the month, which is the 25th, we do tend to historically see some weakness on this day. And even historically, we tend to see some weakness with the S&P 500. We're still trying to figure out where we're at in this map of October when we're looking at a sitting president who's running for re-election. Also, the Carson research suggests that historically we might see some weakness. The NASDAQ also suggests some weakness, and the S&P suggests some weakness before we finally see the end of October show a little bit more positive price action. We tend to be up more than down with the S&P 500 going back to 1950 when we just look at pre-election years. Bitcoin still has a bit of a bounce underneath it right now, so possibly it's hanging into this green line, which is the positive seasonality. And now we're getting up into the 34,000 range. It actually got up into the 35s for a while before pulling back slightly. And we spend a few days above this, and we could actually see a golden cross. So the scenarios, we're leaning more towards the down one right now because that's what our charts are suggesting. I wouldn't necessarily go with the sideways one right now, even though I have it highlighted. If you set up some positions when we were going sideways, and depending on how you lean them, whether they're more bullish or bearish, but you probably just want to keep a pretty close eye on any of those positions. So the warning signs, longer term, we're still looking more negative with our long-term equity put call ratio. The risk on posture is still showing weakness. Our oscillators suggest that momentum is still negative for the S&P and the NASDAQ 100. The BPI is back to crossing below 30. The vortex is negative, as is the parabolic. The 50-period new highs, new lows exponential moving average study continues to be negative. The Russell, the small caps, and the mid caps have generated recent death crosses. Positive signs. We're still wondering what's going to happen with the daily special K chart. The equity put call ratio based on 5 periods, that's continuing to decline, and that could be a little diamond in the rough in the background. The Copic curve, it's still generating an official buy signal, but it's really starting to fade away. The Pring bottom fisher, I don't know if we can really pay attention to that right now. Small and mid-cap growth is positive. The financial sector is still below its 200-day simple moving average, even though it does have a golden cross, but that could change in the next day or two. So our conclusion, we're negative. We do have a confirmed trend, and that trend is negative, but now we've gone back above long-term support, meaning the 200-day simple moving average. In the short term, we're still negative, but we're just working off of that oversold condition that we've been seeing. Intermediate term, we're still negative, but we're back above support, meaning we're above the 200-day simple moving average. So we can switch our long-term view back to positive. Now, if we fall below that, it's going to quickly get turned back to negative. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.